Okay, let's unpack this. We're doing a deep dive into this enormous, structurally complex, and let's be honest, often anxiety-inducing financial world of student loans.
It really is a world unto itself.
Right. This is debt that's designed specifically for, university or college tuition, books, living expenses, and right away it's a unique beast.
Completely different. It's not like a standard consumer loan or a mortgage.
Exactly. They often have these lower interest rates at the start, and this is the big one deferred repayment while you are still in school, while you're actually learning.
And that sounds so consumer-friendly on the surface, doesn't it?
It really does.
It does, but those borrower-friendly features, they kind of mask the fundamental distinction that makes this debt so different and so risky across the globe.
Okay, what's that?
We're talking about the really strict legal protection that these loans get, specifically around renegotiation and bankruptcy.
All right.
Once you sign for a student loan, in many places, it is incredibly difficult, almost impossible, to get rid of that debt, even if you face genuine dire financial trouble later in life.
So that legal shield, it shifts all the financial risk.
It does. And what's so fascinating is seeing how different countries manage that risk. In some places, the risk is carried by the state or, and this is surprising, sometimes even the universities themselves.
So our mission today is to be your guides through this global financial maze. We've got sources that compare systems all over the world and others that take a razor-sharp look at the behemoth that is the United States system.
We're going to dissect everything, from countries where, debt collection is handled like a supplementary tax,
All the way to places offering zero interest incentives. And we have to grapple with the sheer, just daunting size of the U.S. system, that $1.6 trillion debt load from 2020.
Exactly. We need to understand the policy choices that decide whether this investment is, for you, a path to financial freedom, or if it becomes a decades-long ball and chain.
We're looking for those aha moments in how these policies are designed. How do different governments structure this to encourage access, but also try to avoid massive default risk?
Precisely. And I think we should start with what are, to me, some of the most radical and efficient approaches. Systems where repayment is it's built right into the national income and tax structure.
Making it almost automatic.
And totally conditional on you earning a living wage.
When we look at countries like Australia, New Zealand, the UK, they seem to have recognized that education is this kind of conditional public investment.
That's a great way to put it.
The government invests in your education, and you pay that investment back when and if you get a direct financial benefit from it.
It's a complete philosophical pivot. It's moving away from treating education debt like a normal commercial contract. Let's start with Australia's system, the Higher Education Contribution Scheme, or HECS-HLP.
Okay.
The key insight here, and this is so crucial, is that the student funding from HECS-HLP is legally and functionally not considered a normal commercial debt.
Okay, let's unpack that. If it's not a normal debt, what does that mean in practical terms for someone who just graduated?
It means the whole collection process is completely separate from traditional banking or credit enforcement. Repayment happens through a supplementary tax.
Not a tax?
Yes, and it's on a sliding scale that's directly tied to your annual taxable income. This makes sure that repayments are only made when you, the former student, cross a specific income threshold that can actually support those payments.
So if you're unemployed or you're earning below that line,
you owe nothing. The debt just sits there patiently waiting for your income to rise. It creates this powerful built-in safety net. It protects borrowers from financial ruin during, low earning periods or career changes.
Sounds incredibly fair. But our sources flagged a really interesting behavioral response to this, a big policy consequence.
Yeah.
If repayment is tied to filing an Australian tax return, what happens if I graduate as, say, a highly skilled engineer and I decide to take my skills and my high salary to London or Silicon Valley for the next decade?
That is the critical flaw. Or maybe, the unintentional incentive that the HECS-HLP scheme has been criticized for.
Right.
Because they tied repayment exclusively to their own internal tax system, any highly educated person who moves overseas and stops filing an Australian tax return, well, they effectively stop making repayments.
So Australia educated you. You have all this human capital, but they lose the financial return on that investment.
It's a perfect real-world example of policy design accidentally creating an incentive for a brain drain. The country invests in talent only to lose it to global competitors who didn't pay that initial cost.
And the economic cost of educating and then losing those high-earning graduates has to be huge. You're losing both the tax revenue and the productivity of that worker.
Absolutely. They actually had to bring in new laws recently to try and track and compel people overseas to repay, which just goes to show how serious that leakage problem became.
Okay, so now let's look at New Zealand. They take this conditional repayment idea and add another layer, an even more aggressive incentive to keep their talent at home.
Zero interest for residents?
That's a huge deal.
New Zealand's system is a masterclass in incentivizing residency. The loans are pretty comprehensive. They cover fees and living costs for full-time students. Part-time students just get fees covered. But the core mechanism, this zero interest rule, it changes the entire equation.
How so?
As long as you are a resident of New Zealand, no interest is charged on your loan balance, period.
So the debt doesn't grow? You're only ever paying back the principal, the money you actually borrowed in the first place. That completely changes the math for long-term financial planning.
It makes the debt so much more manageable, and like Australia, they've automated the collection process beautifully. Repayment kicks in when your income goes over a minimum threshold.
And the employer just takes it out.
Yep. Employers automatically deduct the repayment from your salary. It's a fixed rate, 12 cents on the dollar, and it's collected directly by New Zealand's tax authority, the IRD. It's integrated, it's efficient, and because the principal isn't ballooning, it really feels more like a public service arrangement than a crushing financial burden.
All right, let's pivot to the United Kingdom. We're moving across the Tasman Sea. The UK uses that tax collection mechanism too, but they handle the interest part very differently. This is where we start to see a bit of a compromise.
Yeah, a compromise between, say, consumer protection and fiscal reality. The UK system, which is run mostly by the state-owned Student Loans Company, or SLC, is famously complex. It's evolved through all these different plans, Plan 1, Plan 2, now Plan 5.
And unlike New Zealand, the interest starts ticking right away.
Immediately. Interest begins to accumulate as soon as you get the loan funds. However, like Australia, repayment is deferred until the tax year after you finish or, drop out of your education.
So the debt is growing from day one, but the actual obligation to pay is paused until you're theoretically out there earning an income. And since '98, they've also used the HMRC tax system for collection, just like their Commonwealth neighbors.
Precisely. Repayments are collected by HMRC and are calculated based on your current income. If your income falls below a certain threshold, and that threshold changes depending on your loan plan, you don't have to make any repayments.
Could you give an example?
Sure. For loans taken out in the 2012-2013 tax year, the threshold was £21,000. So if you earned $20,999.9, you paid nothing, but the interest kept on accruing.
That accumulating interest is the critical difference, isn't it? It means the loan balance is constantly getting bigger, which could be devastating if you spend years in a lower-paying field.
It can be, but the UK system offers the ultimate safety valve, forgiveness.
The long-term safety net.
Exactly. It's built right into the structure. Loans are always canceled if the borrower dies or becomes permanently unable to work, and they're also canceled after a specific amount of time. Traditionally, this was 30 years.
But our sources flagged a huge policy shift here. It seems to reflect the rising cost of education and the government trying to get more of its investment back.
This is a major area of controversy right now. It's the shift to what they're calling Repayment Plan 5. For this newest group of students, starting from January 2025, the cancellation period is being extended from 30 years to a staggering 40 years.
40 years. Let's pause there and process that. If you start making payments at, say, 22, you will be on the hook for that student loan until you are 62 years old.
Potentially well into your retirement years.
It basically converts the debt into a lifetime obligation for anyone who doesn't earn enough to pay it off faster.
It creates enormous financial uncertainty that can span an entire career. It really raises questions about whether that's a safety net or just a prolonged commitment. And speaking of prolonged commitments, the UK also has this fascinating, complicated history with its early 1990s loan portfolio.
Right. This highlights the administrative nightmare that can happen when you try to move debt collection away from that central tax system.
Exactly. Loans that were issued between 1990 and 1998 were not collected through the seamless tax system. Instead, the student was totally responsible for proving their own financial distress.
So the burden was on you, the borrower.
The onus was entirely on the loan holder to actively prove, usually every year, that their income fell below the deferment threshold if they wanted to pause their payments.
That sounds like a constant bureaucratic headache.
It was. And then, in 2013, this specific portfolio of early loans was sold by the government to a private company called Erudio.
So suddenly you're not dealing with the government anymore.
Nope. Suddenly, graduates who signed up for a government-managed plan were dealing with a private entity where they had to constantly prove their poverty to avoid having to make repayments.
And what happened? What were the consequences of that?
Collection issues just soared. We saw complaints that even graduates who had fully repaid their loans or who were properly deferred were still having large amounts, we're talking up to £300 a month, taken from their accounts without reason.
And I imagine getting that money back was a nightmare.
Oh, an immense administrative labyrinth to get those deductions stopped and get the money refunded. It goes to show that even in a highly centralized system, selling off debt portfolios carries huge risks for the borrower.
So we've seen that tax-based collection is a really powerful global model. But if we expand our view, we see countries using these unique, sometimes surprising enforcement tools that go way beyond just tax collection.
Absolutely. The contrast between these systems and, the U.S. system we're about to get into really emphasizes the sheer range of solutions out there. Let's look at Canada, specifically British Columbia. They introduced a non-financial penalty that's a really powerful compliance tool.
What's so interesting here is that the penalty doesn't hit your bank account or your credit score in the usual way. It hits your mobility.
That's exactly right. In British Columbia, the Insurance Corporation of British Columbia, the ICBC, which manages all driver's licensing in the province, they can actually withhold the issuance or renewal of your driver's license if you're delinquent on student loan repayments. They enforce it alongside other debts, like unpaid court fines or child support.
I have to stop there. Just imagine that for a second. You can't drive to your job, which is how you earn the money to pay the loan, because you haven't paid the loan. That's a textbook debt trap.
It's a drastic measure, for sure, but it highlights the immense policy control the government has over the system. And it's all directly government-controlled, which lets them use these really specific, non-traditional enforcement tools like a driver's license freeze to make sure people comply.
Okay, moving over to Asia. South Korea adds this incredibly nuanced layer to the discussion that links financial risk directly to your academic choices.
This is one of the most compelling bits of data we found. South Korea's loans are managed by the Korea Student Aid Foundation, or KOSAF. It was set up in 2009 with this very ambitious philosophy. No student should quit studying due to financial reasons.
A noble goal.
Very. They see their role as helping students grow into talents that will serve the nation. But the market reality seems to clash with that idealism when it comes time for repayment.
How so?
It absolutely does. KOSAF found that the default rate is directly correlated to a student's academic major. When you compare them to other fields, students in, for example, fine arts and physics have a statistically higher default rate.
That is counterintuitive. I would expect maybe some vocational degrees, but physics.
It suggests that while the ultimate payoff from a physics or fine arts degree might be immense, in research or teaching or cultural contributions, the immediate job market and the predictable salary trajectory are riskier. This leads to higher rates of initial unemployment or underemployment.
Which in turn makes it harder to repay the debt.
Exactly. So the data is telling the government that an investment in certain fields carries a higher financial risk of not being paid back. And KOSAF recognizes a broader implication here.
What's that?
They acknowledge that a long period of unemployment right after graduation tends to lead to an inferior quality of human capital. This means the default isn't just a number on a ledger, it's a social and economic problem where your educated workforce isn't being used efficiently.
It forces the question. If the government values those fields, shouldn't the financial risk be shared differently?
That's the heart of it. That kind of data makes the decision of what you study an immediate, potentially punitive financial calculation, not just an academic one.
Now, switching gears to India, we see a focus not on enforcement, but on this massive, rapid scaling by the government to manage the sheer volume of student financing they need.
India had an enormous logistical challenge. How do you coordinate loan access for that massive student population? So to deal with it, the government launched the Vidya Lakshmi portal in 2015.
A central hub.
Exactly, a single centralized hub for any student looking for an educational loan. It streamlines the whole discovery and application process.
To pull something like that off in a country the size of India must have taken incredible cooperation.
It was a huge undertaking. The portal was developed under 3 major government forces: the Department of Financial Services, the Department of Higher Education, and the Indian Banks Association. and the adoption was lightning fast. By August 2020, just 5 years after launch, 37 different banks were on the portal, offering 137 different loan schemes.
That level of centralization is about efficiency, but it also reflects the massive growth they were expecting in that sector.
Oh, the projected growth rates were astronomical. It shows a huge reliance on debt financing. The sector was expected to grow by over 32% in 2009-2010, then almost 40% in the next 2 years, and peaking at a projected 44.8% between 2012 and 2015.
So a big government pivot toward access through loans.
Yes, rather than just public funding alone. It's also important to note they did launch a countermeasure, the Vidya Sarathi portal, which was specifically to help students find scholarships, trying to balance the loan-heavy growth with grant aid.
And lastly, let's briefly touch on Hong Kong, which is an interesting case study in a more historical geographical rollout.
Hong Kong gives us a clear example of a phased, risk-managed implementation. The original loan scheme was introduced pretty early, back in 1969, but it was initially restricted to students at just 2 major universities: the Chinese University of Hong Kong and Hong Kong University.
So they could test the model in a limited way.
Exactly. And as the scheme proved it was viable, they expanded it institution by institution over the next 2 decades.
So they rolled it out slowly.
Very deliberately. To the Hong Kong Polytechnic in '76, then the Hong Kong Baptist College in '82, and finally the City Polytechnic in '84. This slow approach minimized systemic risk. They also had a strict residency requirement. Applicants had to have lived in Hong Kong for 3 years right before applying to make sure the public investment benefited long-term residents.
All right, we've seen integrated tax models, driver's license penalties, even risk based on what you study. Now we pivot to the system that is arguably the most confusing, complex, and financially burdensome for the average borrower, the United States.
And if we connect this to the bigger picture, the U.S. system is really defined by its massive scale, its unique public-private structure, and its very specific rules about risk.
Or a lack thereof in some cases.
Well, exactly. The U.S. system is this complex landscape. You have federal loans, which are either subsidized or backed by the government, and then you have private loans. The distinction is so important because the overwhelming majority, a staggering 92% of all student debt, is federal.
And that 92% figure is why we have to focus so heavily on federal policy. Within that federal category, you have subsidized versus unsubsidized, which is all about how the interest works while you're still in school.
That's the first hurdle for any borrower to understand. Subsidized loans are the gold standard. The interest does not accrue while you're enrolled in school at least half-time.
Which is a huge benefit.
A massive benefit, but it's restricted. They're only available to undergraduate students who can demonstrate financial need. Unsubsidized loans, on the other hand, start accruing interest immediately from the moment the money is sent out, regardless of your financial need or academic status.
So even while I'm in school, that unsubsidized loan balance is already growing before I've even earned my first paycheck. It's also really important to understand the big structural change that happened in 2010 about who was actually lending the money.
That 2010 change was a major restructuring. Before then, federal loans were split between direct loans, which were funded and originated by the government, and guaranteed loans.
Which came from private lenders.
Right, they were originated by private lenders, but the government guaranteed repayment if the student defaulted. That guaranteed lending program was eliminated in 2010.
Why? Why was the government guaranteeing private loans to begin with, and why did they stop?
The initial idea was, to leverage private sector efficiency. But the system came under heavy criticism because the government guarantee essentially removed all the risk for the private lenders.
So they couldn't lose.
Exactly. Critics argued this just boosted the profits of private student lending companies without actually reducing costs for students. It created a perverse incentive. The private lenders made money whether the loan was repaid by the student or by the taxpayer. Getting rid of that brought all federal lending into the direct loan program, consolidating both risk and control within the government.
And if a borrower has multiple federal loans from different years, there's a way to simplify that, right?
Yes. The federal government offers direct consolidation loans. The new interest rate for the consolidated loan is based on a weighted average of your previous loan rates. It's generally straightforward and designed to make repayments simpler. But, and this is key, private loans are completely excluded from this.
And private loans have totally different interest rate dynamics anyway.
That's right. Federal rates are set by law, by statute. But the interest rate for a consolidated private loan depends on external market factors, usually the London Interbank Offered Rate, or LIBOR, or its reimbursement. It just highlights the fundamental difference. One is a regulated government product, the other is a market product.
This brings us to what I think is the most unique part of the U.S. system, the qualification paradox. In normal lending, I qualify for a loan based on my assets, my credit history, my ability to repay. Federal student loans just throw that model out the window.
They completely turn traditional underwriting on its head. Here's the key takeaway. Most U.S. college students qualify for federal loans, period. They can borrow the same amount of money at the same price, regardless of their own income, their parents' income, their expected future income, or their credit history.
Wait, so we're giving out loans blindly, assuming an ability to repay later. That sounds incredibly reckless from a financial perspective.
It is from a traditional perspective. But it's an explicit policy decision. It's designed to ensure universal access to education. It's a deliberate choice to decouple the investment in education from personal credit risk.
Which is great for access.
But it transfers all the risk of that loan not being repaid onto the government and therefore the taxpayer later on. The exclusions for who can't get a loan are minimal and very targeted.
So who actually gets excluded from federal loans?
It's a very short list. Generally, only students who have previously defaulted on a federal loan or those who have been convicted of a drug offense and haven't completed a rehab program are excluded. For the vast majority of people, the federal money is available.
And the amount you can borrow is capped each year based on your academic status.
Correct. The borrowing limits depend on your education level, undergrad versus grad, and your dependent or independent status. Graduate students can borrow a lot more per year, and that's a point we'll come back to, because it makes those loans particularly profitable for the federal government.
So if I'm a student and I need more money than the federal limits allow, say my private university tuition is sky high, that's when the traditional credit-based private lender comes in.
That's exactly when. Private lenders are the source of funds only when a student has maxed out their federal borrowing limits. And they use traditional underwriting criteria. They're looking at your credit rating, your income levels. The system essentially funnels the students with the greatest need for more money into the hands of traditional lenders who charge higher rates based on that risk.
Some scholars we looked at argue for just eliminating the federal borrowing limit entirely. Why would they suggest that?
The argument is purely pragmatic. If the government allowed students to borrow according to their full need-covering tuition plus reasonable living expenses, they would eliminate the reliance on these high-cost private loans. If you can get enough lower-interest federal aid, the need to go to a high-interest, risk-assessed private lender just disappears.
It would, in theory, make financing cheaper and safer for the neediest students.
That's the argument.
Now let's talk about the financial dynamics of the federal system, because this is where politics and budgeting really intersect. Federal interest rates are not market rates. They are set by Congress.
That's the key structural difference. Federal student loan interest rates are set explicitly by congressional statute. And because the rate is dictated by a political body and influenced by budgetary goals, it has historically resulted in a profit for the federal government.
That sounds incredibly problematic. The government is making money off its citizens who are investing in their own education.
It is a major, major point of criticism. In 2010, the federal student loan program generated what is officially called a multi-billion-dollar negative subsidy.
Which is just government speak for profit.
Exactly. The profit comes from the difference between the government's low cost of borrowing money and the higher interest rates that students are required by law to pay. It raises a serious policy question. Should a government entity be designed to profit from education debt?
And compounding this is the tax disadvantage. If I take out a loan for a business, the interest is tax deductible. But for my education, it generally isn't.
This is a major structural criticism from economists. Interest on most business investments is tax deductible to incentivize growth. By contrast, student loan interest isn't treated the same way. Critics argue that this tax disadvantage effectively penalizes investing in human capital. By making it financially harder to service education debt, the system contributes to a shortage of educated labor and slower economic growth.
It sends the message that investing in equipment is a better financial move than investing in people.
Precisely. And this leads back to that idea of societal returns we mentioned earlier. If the government is profiting but the student's degree provides immense public benefit, why should the student carry all the financial risks?
So this is proposal.
Yes, this fascinating proposal that federal loan rates should be adjusted based on the specific course of study relative to its rate of risk and the societal returns it generates. A societal return calculation would look beyond just your personal salary. It would consider things like reducing stress on public services, think healthcare professionals or teachers, or promoting general employment rates. It shifts the financial calculus from how much will this person make to how much public good will this field generate, and then adjust the loan rate.
The U.S. system, with its wide access and minimal underwriting, absolutely needs a strong safety net for when students actually start repaying. This brings us to the core mechanism for that. Income-based repayment, or IBR.
IBR is a lifeline, but it is complicated. It's an alternative repayment plan, and it's only for federal student loans, which is a major distinction from private debt. Its fundamental function is crucial. It lets you base your monthly payments on your current income, not on the massive amount of money you actually owe.
So it's kind of like the income-linked tax systems we saw in the UK and Australia. The payment is proportional to what you can afford. How is it calculated?
IBR plans generally cap your loan payments at 10% of your discretionary income. This means if your income is low, your payment will be low, sometimes as low as $0. But, and here is the crucial complication, the source of immense anxiety for millions of borrowers. While your payments are capped, deferred interest still accrues.
So you could be making your 10% payment every single month, feeling responsible. But because that payment doesn't cover all the interest that's adding up, you look up after 5 years and realize you owe way more than you did when you graduated.
The principal is growing, even while you are faithfully paying. That's the growing balance problems. Like only making the minimum payment on a high-interest credit card, your debt just compounds. But this growing balance is eventually dealt with through loan forgiveness, which is the big incentive to stay in the program.
And the timeline for that forgiveness is different depending on where you work, which is a clear government attempt to incentivize public service.
Exactly. It's split between public and for-profit sectors. If you work in the public sector for the government or a nonprofit, forgiveness is granted after only 10 years of qualifying payments. And this is vital. Loans forgiven through the Public Service Loan Forgiveness Program, PSLF, are not considered taxable income.
Which makes PSLF a really powerful financial benefit.
It's huge. But if you work in the for-profit sector, the forgiveness period is much longer. It extends out to 25 years.
And those 25-year cases come with the huge risk of the tax bomb.
They absolutely do. Under standard IBR forgiveness, the forgiven debt is currently treated as taxable income by the IRS, unless you're bankrupt or insolvent at the time. So imagine getting a tax bill in year 25 based on, say, $100,000 or $200,000 of forgiven debt.
That one massive tax bill could be financially ruinous.
It could. It leaves borrowers wondering whether to celebrate the end of their debt or panic about the immediate tax hit.
Let's zoom out now to the scale of this problem. We're talking about $1.6 trillion in debt. This crisis is tied directly to a fundamental policy shift over the last few decades.
Yes, the rising debt crisis is tied directly to how federal aid policies evolved. The government expanded loan eligibility, making it easier to borrow, while at the same time shifting the emphasis dramatically away from grants money you don't have to repay and squarely toward loans.
And you can see that shift just by looking at the Pell Grant, which is the main federal grant.
The numbers show the gap perfectly. For the 2019-2020 school year, the maximum federal Pell Grant was $6,195. That's the most free money available to the neediest students. Now contrast that with the average annual tuition for a 4-year in-state public university for that same period, $26,590.
That's a massive shortfall. That one comparison alone shows why students are forced to rely on loans. The gap between the max grant and the cost of school is just too wide to bridge with savings or income alone.
Exactly. The government made access easier, but they drastically cut back on the free money, forcing students deeper and deeper into debt to make up the difference. And this was made so much worse by public spending cuts at the state level, which is where many public universities get their funding.
Between 2002 and 2012, public funding for education dropped a lot, while enrollment skyrocketed. That's a perfect storm for tuition hikes.
It really was. Between 2002 and 2012, public spending on education dropped a massive 30% per student. In that same time, total enrollment at public colleges jumped 34%.
More students, less public money per student.
Meant the cost had to be shifted somewhere. It was shifted to student tuition, leading to drastically more debt. The burden of funding public education was transferred from the state budget to the individual student borrower.
And we can't talk about rising debt without highlighting the disproportionate impact of for-profit universities.
This data is so critical for understanding the risk here. For-profit universities enroll about 10% of active college students in the country. but they hold nearly double that share, almost 20% of all federal student loan debt.
So a huge concentration of debt.
Yes, and it suggests that these institutions, which often have low graduation rates and high costs, are generating a lot of borrowing without delivering the positive income outcomes that you need for repayment.
Let's focus now on the default crisis itself. Who is most likely to default? What are the demographic factors?
The risk of default is not spread evenly. Data consistently shows that default rates are higher for women than for men. They're also much higher for borrowers from low-income families, which you'd expect. But there's one factor that points directly to inefficient investment: borrowers who enter repayment after only their sophomore year.
So students who dropped out, they didn't get the degree that would dramatically increase their earning potential, but they still have the debt.
Precisely. They took on the debt but got an insufficient return on their human capital, putting them in the highest risk category for default. On the flip side, some loans are considered exceptionally profitable for lenders.
And those are the loans to grad students.
Loans to graduate and professional students, yes. They're especially profitable for both the federal government and private lenders. Why? Because they typically have high interest rates but are associated with the lowest default rates, given the generally higher and more stable earning potential that comes with an advanced degree, like from law or medical school.
The Great Recession also had a big impact on student loan defaults, right?
Right.
It connected this debt crisis to the broader economy.
The recession was a shockwave. Default rates grew to nearly 30% during that period. Studies from that time show that the default rate is strongly related to non-traditional issuers and, critically, the price of tangible assets. There's an inverse correlation.
Meaning?
When tangible asset prices, like housing, fall rapidly, like they did in 2008, default rates tend to rise. The collapse of the housing market and the rise in unemployment directly linked the student debt crisis to the broader economic recession.
And while we often focus on young graduates, the data on older generations carrying this debt is just sobering.
It truly is. As of 2013, we had data showing that for borrowers aged 65 to 74, a staggering 30% of their own education loans were in default. On top of that, around 17% of parent PLUS loans debt taken out by parents for their kids for that same age group were also in default.
So the debt burden extends well into retirement.
Yes, impacting seniors who should be financially secure but are instead dealing with collections and wage garnishments.
All right, let's turn to the legal foundation that makes U.S. student debt such a financial prison: the bankruptcy shield. This protection is the single biggest factor that separates it from almost every other type of consumer debt you can take out.
This is the legal cornerstone of the whole controversy. Student loans cannot be discharged in bankruptcy unless the borrower can prove that repaying the loan would create an undue hardship for them and their dependents.
And that undue hardship standard is notoriously high.
Incredibly high. It generally requires proving that you can't maintain a minimal standard of living, that this is likely to persist for most of the repayment period, and that you've made good faith efforts to repay the loan. It's a very difficult bar to clear.
And it wasn't always this way for all student debt. A big law change in 2005 expanded this shield to cover private loans too.
That 2005 change was transformative and highly controversial. It changed the bankruptcy laws to prevent even private educational loans from being easily discharged. Before this, private loans, which are often riskier and have higher interest rates, were treated more like regular unsecured consumer debt.
And critics argued this created a credit risk-free loan for lenders.
A credit risk-free loan. Think about the financial incentive that created for the lender. It meant that lenders knew, no matter what happened to the borrower financially, that the debt would follow them forever. It couldn't be erased through bankruptcy. This certainty let lenders average returns of about 7% a year because they no longer had to price in the risk of the loan being discharged. It fundamentally changed the risk profile.
And did this change borrower behavior?
There's evidence to suggest that since bankruptcy was no longer an option for these loans, it may have reduced a debtor's intention of trying to reduce costly defaults by declaring bankruptcy. If that ultimate safety valve is shut off, you're just left to deal with the consequences of default instead of seeking a managed legal reset of your finances.
Now here's where it gets really interesting. We have concrete evidence of misconduct and anti-competitive practices within the industry itself, which led to some high-profile legal battles.
The most notable example is the 2007 investigation led by the New York Attorney General at the time, Andrew Cuomo. This investigation targeted lending practices and these anti-competitive relationships between major lenders and universities.
What exactly did they uncover about these relationships?
The investigation found that many universities were steering their students toward a select group of preferred lenders. And while these were advertised as being good for students, the preferred lenders often offered higher rates than other options on the market.
And there was more.
Yes. Here's the most concerning part. Some of these preferred lenders allegedly rewarded university financial aid staff with kickbacks, payments, gifts, other financial benefits for directing students toward their high-rate loans.
That is a clear conflict of interest. The financial aid staff, who are supposed to be helping the student, are recommending expensive loans for personal gain. What was the fallout from that?
The fallout was significant. It led to major policy changes and cleanups in lending practices at many American universities, and millions of dollars in fees and interest were rebated back to the students who were affected. It exposed a systemic effort to exploit students.
And there was another major case, a whistleblower suit, from a former Department of Education researcher.
That was the 2007 false claims lawsuit filed by John Oberg against major players like Sallie Mae and Nelnet. Oberg alleged that these massive lenders had been knowingly overcharging the U.S. government on interest guarantees and administrative fees, defrauding taxpayers of millions.
And that case was settled.
It was. Nelnet settled the lawsuit in August 2010, paying $55 million. These cases just show that the complexity of the system created so many opportunities for misconduct, aimed at both the student and the taxpayer.
Despite the staggering $1.6 trillion debt figure, the debate over whether this is an economic bubble is still going on, with comparisons to the housing crisis.
That's a common point of contention. As of 2013, some economists were predicting that this estimated $1 trillion of debt could trigger a new economic crisis by impacting the spending power of millions of graduates. But it's important to note that most economists and investors at the time believed there was no true student loan bubble in the same systemic sense as the housing market.
So the risk was high for individuals, but not catastrophic for the whole system.
Right. It was seen as high for individuals and certain parts of the economy, like car sales or home purchases by graduates, but not systemically catastrophic in the same way mortgage-backed securities were.
But regardless of what you call it, a systemic bubble or a humanitarian crisis, the debt burden has become a central political issue.
Absolutely. The sheer size of the debt has forced a political response. During his 2020 campaign, Joe Biden promised student loan forgiveness. And that promise was backed by a lot of public demand. A 2022 survey showed that 64% of Americans supported $10,000 in student loan forgiveness for individuals earning up to $150,000 a year. It just highlights the widespread recognition that the current debt levels are financially unsustainable for a majority of borrowers and that some kind of policy intervention is needed.
So what does this all mean for you, the person listening to this? We started by saying that student loans are a highly unique kind of debt. But this deep dive really shows just how radically different the policy choices are around the world.
That's right.
In Australia, the UK, and New Zealand, repayment is tied to your income and collected like a tax. They've effectively built an income-based safety net right into the system.
And that stands in such stark contrast to the United States, where the debt is heavily shielded from bankruptcy. It creates a near-permanent, high-risk financial obligation for you, the borrower. The U.S. system's fundamental failures really involved expanding eligibility while cutting back on grants, which led to the federal government actually profiting that negative subsidy from its own students.
So income-based repayment, while it's a vital necessity,
It's ultimately a reaction. It's a reaction to a debt that's almost impossible to discharge and that continues to balloon because of all that accruing interest.
what's so fascinating here is this persistent global tension, this push and pull between public investment and private burden. We highlighted that proposal that federal loan rates should be adjusted based on the rate of risk and societal returns from different fields of study.
And that raises the final, provocative question that really defines this entire policy area. Let's go back to that South Korean example, where students in fields like fine arts and physics face a demonstrably higher default risk, suggesting their fields have a poorer immediate market outcome.
Right.
If the financial burden in the U.S. or anywhere shifted away from the individual student's market capacity to repay and instead shifted toward the proven, quantified societal value of their educational field, say clean energy research or early childhood education, would a physics or fine arts student still face that higher default risk?
Or would the government, recognizing the long-term, non-monetary benefit their contribution provides to society, choose to heavily subsidize that field through lower or even zero interest rates?
That is the ultimate policy decision. Is education treated merely as a consumer good, or is it recognized as a fundamental public good worth protecting with our collective resources? That is the question we leave you to ponder.